fascinating. The first guest we have is POLNY, who's one of my favorites, and he's going to be talking about and breaking apart and dissecting Friday's dismal jobs report. So you want to stay tuned to that because he's also the publisher of Gold 2020 Forecast. And I don't know if you saw what gold did on Friday, but intraday it went up like $40. So again, that's at 10:33 a.m. That's Bull Polney, and this is Don Bennett. Welcome to Financial Mythbusting. And we had quite a week last week. Well, I'm going to talk about the hints of truth that are seemingly all around us. In particular, uh, especially this last week, the financial media was just full of conversations about whether our own Federal Reserve is going to hike rates on us. And I mean, well, the Federal Reserve itself keeps talking about it too, saying the economy is recovering and the markets are zooming higher, so therefore everything is just A-OK, right? And then these hints of truth start to show up, one of which is in the jobs market. I mean, there are thousands in layoffs in both the energy and the tech sector. For example, Shell Oil Company, they cut more than 2,200 jobs this past 2 weeks, and that's bringing the total losses to 12,500 jobs. Microsoft unveiled job cuts as many as 1,850 job cuts, and they're going to be taking a $450 million impairment and restructuring charge with that. Even Intel plans to cut somewhere between 300 and 350 jobs in Germany. I mean, I'm just going to quit here with this type of layoff list because the list goes on with different corporations. So, to that point, that doesn't mean the economy is doing well. And which makes me ask the question, why then does the Federal Reserve on a weekly basis deceive the public about the real insolvent truth of the U.S. economy? It's like almost everything they tell us is not truthful. I mean, Yellen and team preach that they are about transparency, that everything, but to me, everything they do is just sleight of hand. It's misdirection. It's a shell game is the best way to describe it. I mean, here's even further evidence or hints of truth that came to our point of view this past Friday. Of course, it was the incredible miss and the May's jobs report. It only added 38,000 jobs. That's the lowest since September 2010. And of course, that slams the fact that the headline unemployment number is going to be touted as positive this time, which is what they always do every month, and they shouldn't. The central banks have just created such a mess, and I say central banks worldwide, but primarily in the developed economy and primarily here in the United States. I mean, just think, give it another 10 to 12 months and, approximately 1 year from now, if we continue to get this 30-something only added jobs type of number, and we're going to be at a negative 3% to a negative 4% unemployment. This totally brings to the forefront this disconnect that's going on between good jobs and the jobs number and the unemployment rate, and what motivates the Fed to say what they say. I mean, so much for, again, you hear, according to the Fed, there was going to be this anticipated rebound in the jobs participation rate, and, all this disenchantment with working with them is finally showing up, trying to listen to them, trying to trust them. The labor force participation rate, as we know, promptly slumped in both April and May, and that slid 0.4 basis points in the past 2 months to 62.60%. That's just shy of a 35-year low of 62.4% hit last October. That's not good. This can be seen in the surge of Americans who are no longer in the labor force, who spiked by 664,000 in May, hitting an all-time high of 94.7 million. So as a result, the U.S. labor force has shrunk by over 400,000 to 158,466 workers, down from 158,000 a month ago. And of course, that helped the unemployment rate tumble to 4.7, the lowest level since 2.7. So adding the number of unemployed workers to the people not in the labor force, there are now over 102 million Americans who are either unemployed or who have just given up looking for work. So while we assess the quantitative aspect of Friday's jobs report, which of course can only be characterized as abysmal, and oddly enough, here goes the media again. They were actually blaming Verizon's job loss of 35,000, if you can believe that. It's just, or they're going to blame the weather, one of the two. I think it's just time for us to look at the qualitative aspects of these reports because it's just sad to report what's going on. And that's the type of thing we're going to continue to focus on. So stay tuned. And Bo Polney is here. Polney is a financial trends forecaster and the publisher of one of my favorite reports, Gold 2020 Forecast, which again is an excellent technical analysis of the gold and silver markets. And he also is the publisher of two other reports called the Polney's Exclusive Turn Dates, and that is for the active trader investor who's looking to keep a pulse on the gold and silver markets on a daily and weekly basis, as well as the 2015-2016 Stock Market Index Report. I'm going to have Bo jump into more detail, and that's where I want to start today. Bo, welcome back to Financial Mythbusting.
Don, nice to be here, and thank you for having me back. Nice to speak with you today.
So, where I want to start is the 2015-2016 Stock Market Index. I mean, we seem to be in a market that seemingly continues to go up, but it's not really going up behind the scenes. Can you dive into a little bit of that for our listeners?
Sure, Don. Last time I was on there, I think we were spoken like in November with you. Let's step back and let's just look at the big picture. That's the best place to start because then you'll see really what's happening. 2000, the year 2000, year 2007, and the year 2015. Okay, what you've got is three tops on the markets. So the world markets have made three cycle highs, and they basically triple topped. London, Japan. You can look across all the world markets, give or take price levels. They've all made cycle tops. So in the past 21 years, the markets have made triple tops and they're finished. Now, since the year 2015, what we've had is it's like really ugly looking. It's terrible looking. What's happening is that now since 2015 some markets topped in May of 2015, and for the NASDAQ, we call the exact top on the 20th of July. And now, so what's happened is since 2015, we've had another triple top series forming. Now, this is more on the weekly basis. So you've got triple tops on the U.S. market last May or July of 2015. Then you've got another top occurring in December or November, December when we last spoke. Now we're looking for that drop. So we got the drop in January and in December of December last year. And then we've also had and then the secondary crash that occurred in January. So that was a second leg down on the world market. So that's what we were expecting to happen. We were expecting for lower prices, and then it bounced. So now what's happened is, guess what, Don? It's come back up to make a third and final top, okay? So the world markets now have triple tops across 21 years and now triple tops across the past year and a half, year and a half, say, okay? So now the markets, the setup could not be uglier. The best example I can give of where we're at, it's like you look at I don't know if you've ever been in an opera before, Don.
Right.
But right at the very end of an opera, what happens? They bring you up, and then it comes down. And they bring you up one more time, and then it comes down. And it comes up one more time, and then it's lights out. So that's where we're at, Don, where it's actually at a point where if people are in the market right now, this could not be more dangerous right here.
What you're saying musically and maybe in the market, this is the crescendo. Is that right?
This is it. Absolutely, Don. This is it. Anybody believing in the markets, the top came in last year of 2015. That was the third and final top. Now we have triple tops forming on the weeklies. And then also we got them on the dailies with right shoulders about to collapse and fail. This is ugly, Don. It's terrible.
Just to slow you down a bit, when you're talking about right shoulders, can you go into detail? Because that's a little bit of technical chart and analysis. And I want you to explain to them. We talk about it here on the show, but it's always great to have an expert do it too.
Okay, so think of a body. You've got a left shoulder, and then the head is higher, and then you got the right shoulder. So basically, the right shoulder is lower again. So when a market's form a chart pattern, what they do is you can have a triple top formation and it crashes, or you can have a head and shoulders and it crashes. But both of the chart patterns, they're three, 1, 2, 3. Ultimately, they all end in failure. So if the markets don't explode higher, and so since last year, for example, and the collapse of August, the markets didn't go up in August, they collapsed in August. So that was a failure of a triple top on a 21-year pattern. And so that failed. So the same thing's about to happen now. You've got a triple top on the weekly charts and on the daily charts, which are forming triple tops. Now, all of these, when they fail, they're not like a small drop. It's not a 5% drop on the market that results. You've got 21-year tops, you got 2-year triple tops, and now you got daily triple tops. So you can't break it down any smaller aside from the hourly. So in terms of time, there's so little time left. It's actually scary. And being in the market now, it's just there's nothing but downside now. But this downside is not going to be little. This is going to be epic.
So again, you're talking about technical, and then on a fundamental basis, people can see it by the bond yields that are plunging. And now there's, I understand, over 10 trillion in global debt that has a negative yield, if you can imagine. So every fixed income investor starved for yield is either jumping into the stock market or going on the long end of the yield curve, which is dumb. I just doesn't a major risk is part of the risk factor that you're talking about? Isn't that when central banks start tightening again?
It doesn't matter what the central banks do at this point. See, when we go back to the chart analysis, charts are life. They're basically they're energies of the world, and they ultimately represent people's emotions and energies, and they create chart patterns. And these chart patterns are created in nature. And so what ends up happening, it doesn't matter what the Fed is going to do or if they tighten or don't tighten. The bottom line is that just like in August, when you had the stock market crash, the dollar went down with it too. And then short term, you had the bonds go up. The problem is on this next leg, if the dollar, like I did an interview with Greg Hunter a few months back, and think about this concept, right? You mentioned the word yields, but now imagine if the dollar if the stock market crashed, the dollar crashed with it like it did in August of last year, and the dollar this time dropped, say, 10 to 20%. So even though you got a yield of 2%, you're going to get, if there's a 20% drop in the dollar, that would be a negative 18% yield. So how many investors in the world are going to want to hold those bonds?
Well, I think that most of us don't think about where the value of our money comes from. We don't think about how cash itself has no intrinsic value in reality, but instead derives its value from our faith in the institution that issued the currency. I bring this up because you're talking about it, because I think Americans' faith in our government is moving towards an all-time low. I mean, should we expect, I know the dollar got hit pretty hard on Friday, should we expect the dollar's value to continue to take a hit as a result?
I believe the dollar is going to fall with the stock market very soon, here and now. And so should this happen, and I believe it will, what you're going to see is a loss in faith and confidence. See, the ultimate problem is, or the issue with currency is it's a belief. I believe the dollars has value. I believe currency has value. So you have to believe in it, and then the governments that make it have to back it, right? And so what ends up happening is that if faith cracks, it doesn't take long for the snowball effect. And ultimately what ends up happening is that the faith cracks, the paper that it's written on becomes worth less. Now, it doesn't have to go to zero, but imagine if it lost 10, 20%, overnight or something quickly, that would be very dramatic, and it would create a ripple effect throughout the world. And that's, I see how this is probably going to play out.
Our own Federal Reserve and other central bankers have succeeded somehow in putting off this day of reckoning you talk about. I mean, this year, for example, last year has been marked by, the year before that, terrible economic fundamentals, bad factory orders, international trade, no new business creation. All this is trending south, yet the U.S. economy has somehow, at least it appears on the outside, avoided the larger lapse into a recession we were expecting here on Financial Myth Busting. So what is your forecast for the remainder of 2016?
Well, again, so if we're looking at the equity markets, stock markets, like I said, last interview we did, we had the second leg down on the market. Right. So all that's missed now, Don, is the third leg. And the third leg is a collapse leg. So my outlook for the equity market, stock market this year is terrible. We'll get a bounce, but at first I see a collapse. I see a massive drop. And I don't know how low it's going to go, because cycle analysis does not give me price projections per se. It just tells me how, the massive direction it could go in. But it gives me also amount of days or time that it could fall. And so so for June, here's the problem. We've got a down cycle that's very likely here in June. And the reason being is we've got an incredibly powerful upcycle for the precious metals in June. So, I look at it as if gold and silver had a very powerful upcycle, why? Why would that cycle indicate to be very powerful unless the equity markets are going in the opposite direction?
It's fascinating. On Friday, the Bureau of Labor Statistics reported just 38,000 jobs were created in May, and that was the worst jobs report since September 2010. Yet the markets didn't seem to care. However, one of the most underreported events of Friday, it was the growth of gold and silver that day. I mean, both had big days after Friday's downbeat jobs report. Isn't it fascinating how the press just wants to continue to be in denial about gold and silver's ability to help out the investor, to help out the fellow American?
What is gold and silver? When you buy a house, what do they force you to get? When you get a house, you have to get what? Insurance, right? You buy a car, what do they force you to buy? Insurance. Okay, everything in this world is about. Okay, hey, you want to borrow some money? No problem, but we need to have to take an insurance policy out against that. Same thing, but no one says, hey, if you're worth X amount of money, make sure you have an insurance policy out against your net worth. No one says that ever. Okay, but what is gold and silver? It is the ultimate insurance policy against everything paper, everything. So if you have car insurance, home insurance, and you don't have gold, and you don't own physical gold, very specifically physical gold and silver in your possession, why? Why do you buy insurance, but you don't buy insurance on your ultimate, on your true value, your net worth, even 10%? But no one talks about that, Don, because you're not supposed to. Because basically, gold and silver are the opposite of paper.
Yeah.
So everything paper is paper, and gold and silver are when paper fails, then that insurance policy kicks in and says, here's your money. And so ultimately it's about understanding how the system works. And it's about understanding what gold is, and gold is true wealth preservation. And people who study economics understand history. They know that gold and silver are money. They've been money for 5,000 years. It's just that for the cycle work that I do, basically there's a currency cycle that's been in place for 250 years, 252 years, which ends this year. But that currency cycle specifically, it's been indoctrinated now in our lives for how many 252 years times an average generation of 70 years, 70-year lifespan. How many generations is that, right? So what happens is that after all these years, the people and the families, and you get indoctrinated into paper, ultimately not realizing that truly, wealth and wealth preservation is precious metals. And so, you use paper for transactions, but you need to preserve your wealth and not be confused or tricked as to what, how you preserve what kind of insurance policy you have to hold against any financial calamities or issues. So ultimately, John, this is not about paper. This is about making sure that everything you own, today, especially now, that you do have precious metals as a protection against all the paper that's been created. And literally to infinity, it's just electronic digits. And so, right now, mathematically, if you look for every ounce of gold they've sold, I think there's 550 people in line that think they own it. That's like selling a house 550 times, the same house to 550 different people. What happened? Go ahead.
Go ahead. No, we have about a minute and a half left, and I want you to keep going because this is parting wisdom, I believe, for all the financial myth-busting listeners, and also a way to protect themselves if what you're saying comes to pass.
Right. If gold is going to gold is going to go a minimum, Don, tenfold in value. So if it's at 1,000, it's like 1,250 as of last Friday. This is June 5th today. We're speaking, so Friday was June 3rd. So it's $1,240 or something on gold. Gold is going to go minimum 10,000 minimum. Okay, that's a tenfold increase. So if you hold only just as an insurance policy, your net worth, someone took 10% of their net worth, they bought physical gold or silver, and they're holding it in their possession, they have sustained their purchasing power or their net worth for years to come, because gold will multiply by 10. And so your 10% investment minimum in precious metals will preserve your wealth. And so I'm not even in the markets. I think it'd be crazy to be in the markets. But if people, again, do not own gold and silver, this is so important. If you don't own gold and silver, you don't understand economics. You don't understand what paper is, and you don't understand how economics works. And you've been indoctrinated into 250 years of belief that paper is value, but it's not. It's what burns. Thanks, Don.
Bo Polney is right. I think gold is perhaps the most maligned asset class in the world. And almost on a weekly basis, if not daily, the financial media continues to mock gold and silver, and they publish articles claiming it's a terrible, terrible investment. And I think it's odd that less than 1% of investors actually in the United States actually owns gold, and even less owns silver. And I also find it very odd why it's so important to the financial media to trash an asset class that almost no one actually owns. They must be doing it out of fear. Actually, just forget that question. I'd like to see answers to more of these questions, which is, if owning gold is such a bad idea, then why are the central banks buying it? And why do we rank countries based on the gold reserves they own? And finally, if the goal for central banks is to generate inflation, why is owning gold stupid? I mean, just remember something regarding that last point. Global central banks have completely abandoned the facade that they are trying to generate growth. And, the Bank of Japan's leader even admitted indirectly that quantitative easing and zero interest rates aren't going to work. And even Mario Draghi never uses the word growth anymore. Listen to him talk. He never uses it. And even our own Federal Reserve is concentrating on inflation targets because GDP growth is just impossible. They also don't bring it up. I mean, simply put, central banks care about concentrating on inflation. And the reason for this is because they finally come clean that their primary concern is the bond bubble, not the real economy. And gold is probably the best inflation hedge in the world. During the last inflationary binge in the 70s, it staged one of the biggest bull run in history. And that's all I've got. This is Dawn Bennett with Financial Mythbusting, where the economy and politics collide.